25,130, 20 points lower. 56,700 on the Nifty Bank. So this is flattish kind of open. Mid-cap index is, again, almost unchanged. 20-point change. The small-cap index maybe also not very much at all. And advanced decline is almost 1:1. So it's not as if the broader market out of the gates is doing something very special, something very different. So it's a very flat kind of start. The Nifty heat map gives you a quick sense, as always, of how things are starting up. And then we will go into individual names, etc. So it is a very, very flattish kind of day. There you go. Evenly split. So I think about 25 up, 25 down. Almost, I mean, so neither here nor there. Surabhi.
Yeah, IT is still down. That's the one clear trend. TCS is another 0.5% lower. HCL Tech is approaching its numbers with nervousness. Remember, even for HCL Tech, the constant currency revenue is expected to fall by about 1%. So tech is on the lower side. Infosys is down more than 1% now. So that's one trend. What else? There is BEL lower by 1%. HDFC Life, Bajaj Finance, some of the financial stocks, even Bajaj Finserv, Shriram Finance, a lot of the NBFC names on the lower side. Not that banks are having a much better run. Axis Bank is lower by 0.3%. HDFC Bank is totally flat. And ICICI Bank is not even up 1 rupee. So it's completely flat. No sense of movement whatsoever. The weak side also includes names like Eternal, Hero Moto, L&T and Reliance, by the way, two big stocks, both down 0.5%. And that brings up a 50-point decline for the Nifty. So what is countering it? There's some pharma action on top. Sun Pharma, for instance, 1% higher. There's Lever, there's Titan, there's Apollo Hospitals. That's pretty much it. Don't have a big move on FMCG today. Just a few of these consumer stocks like Lever and Titan holding up. Otherwise, yeah, it's flat with a negative bias. Now 60 points lower on the Nifty. Nigel.
Well, that's right. A few stocks that deserve special mention. Enviro Infra, that's a newly listed company. That, in fact, is moving higher on decent volume. So that's a stock that's on the radar. You have Sona BLW. The stock actually in pre-open was much higher. Now it's holding with a gain of around 2%. Both of them on high volumes. Jane Street, they've gone ahead and they've put in their deposit with regard to the penalty. Now, the hope is that volumes pick up yet again. That's the hope. No confirmation, but BSE, that's the one that I'm talking about. That's up close to around 2.5%. So keep an eye out on that name as well, if in case volumes do start recovering. Because remember, the past week or so, couple of weeks actually, volumes on the exchanges have been far lower than averages. Moving to the other stocks, GE Power, that's falling on large volumes. So that one's coming for some big profit taking, as is the case with Religare. After the big bazooka move that we saw on Friday, Religare is actually lower. And Dream Folks, that downward spiral just continues. So that one as well is struggling this morning. So you have the Nifty, that's lower with a cut of close to around 50 points. The mid-cap index, though, is holding pretty much flattish, which is encouraging, actually. And, I was reading a note from Gautam Dugar this morning from Motilal Oswal. They believe that earnings will be much better in the mid and the small cap space. So that's why they're increasing weightage on the mid and small caps in comparison to the large caps. So the mid caps doing a bit of an outperformance.
BSE, as we were discussing before the pre-open as well, 3% is the biggest volume-led gainer. 10% knock last week. MCX was down 10, but exchanges generally took a bit of a hit. So that Jane news of the margin, will it help? Will it bring some people back? Is the question. MCX is up about 1.25% as well. Polycab is another one, right? 2.5% higher. It's the fourth, fifth largest volume-led name. And then you look at Angel One as well. Angel One is up about 2%. So again, broker 27, 26 or so. Castrol is coming up with a 3% pop, 226. Silver Bees. Look at silver. We were talking about silver earlier. Silver Bees, which are traded 2% higher. I remember silver on Friday was up 4%, and this morning I think they're up a little bit as well, futures. But the big one, of course, came up on Friday's session. Advanced decline now is settling down, slightly down, about 1250 lower, and about 1100. Actually, it's not very much different. Infi is the biggest volume-led loser. IT services is another space after TCS we were talking about. So it's down 1.5%. It's not much, but it is down. So I think TCS has reported a 3% constant currency decline has basically muted expectations a little further. And then, of course, I mean, you got VIP, etc. We will be discussing. Garden Reach and Mazgaon are the two shipbuilders, which are down 4% and 3% respectively. So another sort of area to keep an eye out for. Nigel?
Just a couple of stocks, Polycab and KEI Industries, they are higher. Their case could be helped by the fact that we have a JM Financial note that's come in there. And they've initiated coverage on both these two names. On Polycab, the target price is around 7,900. And on KEI Industries, it's 4,500 rupees. So that's a note that's released today itself from JM Financial. So could be having some kind of impact in initiating coverage on both these two names.
All right, we'll keep an eye out on that one. We'll probably get you updates, the details of that note as well. 50 lower, 25,100 on the index. Vetri Subramaniam is Chief Investment Officer at UTI Asset Management Company. Is with us. Vetri, good morning. Great to have you on the program as always. Prashant this side. Are we heading up or are we heading lower, Vetri? Simple question. It doesn't get more simpler than that. From here, where we are, sort of, is it? And the question I asked that question is because even though last week markets lost a little bit of momentum, they've not really done badly at all, given all the noise around tariffs, etc., and all the other stuff, right? Earnings which have been poor, which continue to be. This quarter is going to be nothing special. So, which way are things weighted, in your opinion, Vetri?
Morning, Prashant. Well, I wish I knew. It's impossible to say what the market will do any given day or any given week. But I think, we as a mutual fund, are looking to deploy money for investors over the much longer term. And I think when you look at that, you have to look at, where you are in terms of the starting point, in terms of valuations. It's a little bit more of a mixed picture over there because, valuations are sort of in the fair value zone when it comes to, benchmark indices like the Nifty 50. But I also think this is a market in which it's more about getting the stock selection right rather than just a top-down focus on, market valuations or single stock valuations. So I think I would just describe it as challenging territory. And I would suggest that the main thing is for investors to have very moderate expectations from equities, given the current starting point in terms of valuations.
That's an important point. Vetri, hi, good morning. And we'll talk about some of the micros in a bit. But on that point, where markets are and how markets have reacted to all the tariff news as well, right? And now the letters that are going out, at least the printed rates are 25%, 30%, 50%, depending on which country you are. But the market has remained completely unfazed. I mean, what would your observation be on this? Is this a sign of wisdom or is this a sign of overall market complacency, which then maybe could be a new risk?
But let's just slice and dice it a bit. I think clearly, all the factors that you're talking about has heightened the uncertainty in the marketplace. It's heightened the uncertainty in terms of corporate decision making. So, I think clearly we are seeing companies hold back on large capex announcements because of the fact that the global value chain is now splintering. And this is particularly true of, large investments in the tradable goods area. I think this is true not just of India, but even on a global basis. Any entrepreneur is doing the obvious thing when faced with uncertainty. It's a little bit like driving in heavy rain in Mumbai. You just slow down simply because your visibility is so much slower. And I think some of that will translate into slower decision making. It will show up in the earnings. And it's interesting since you mentioned, earnings, the market sort of back to where it was, 7, 8, 12 months ago. But in valuation terms, even though you've rolled forward a year, in valuation terms, it's not really cheapened very significantly. And I think, therefore, given the risk to earnings, I would still worry a little bit about that. In a global context, it's quite interesting because when you look at the US, the bond market is talking about 2 rate cuts through the rest of the year, which suggests the bond market is expecting softer data. But you look at the equity market, and the cyclical component of the equity market in the US is significantly outperforming the defensive part of the equity market, which is a little bit of a dichotomy that you've got the bond market pointing one way and you've got the equity market pointing the other way. And sooner rather than later, only one of these theses is going to play out. Both can't play out.
Absolutely. I guess the equity market only wants to read one way, and that is up. Whether you talk about real wars or trade wars or currency situation, inflation, the equity market just wants to read up. By the way, our market is flashing down. I just wanted to, as I hand it over to Nigel, we're almost a 90-point drop now on the index. Watch out for a sharp fall in stocks like Bajaj Finance and further cuts on big stocks like L&T as well. And IT anyway has been weak. So it's now turning out to be slightly lower after the start.
All right. Hi, Vetri. Good morning. Good to see you, Ben. You're sounding a little bit cautious on the headline index itself. So you wouldn't be in the camp that believes that mid and small caps are the way to go. I was reading a note from Motilal Oswal earlier this morning, and they have said that after a while, they are feeling a little better about mid and small caps because the earnings growth will be far better than what the large caps will do over the next 12 to around 18 months, or 18 to 24 months. How would you position yourself in terms of investments in the equity market?
So if you just roll that back, Nigel, look, all returns that you got out of equities are a function of where you are in terms of starting valuations and then what you get in terms of earnings growth. There is some evidence that, I would say certainly looking at the quarterly outlook, that the earnings prospects in the current quarter, or rather the quarter completed, are better for mid and small caps compared to large caps. But if I look at the FY26 numbers, I'm not able to see a very big gap. And therefore, given that the starting valuations are already a lot more elevated in the mid and small, I'm not sure that the superior earnings growth by itself will do enough to outweigh the pressure from the starting valuations being higher. So you've always got to look at it in a combination. The market is never driven by a single factor. It's always multi-factor. And I would say the two key elements that I as an investor have always learned to look at is where are you in terms of starting valuations, where are you in terms of earnings growth. So you've got to look at both together rather than only where is the best earnings growth. And history is replete with examples about, companies which have compounded earnings growth at, very healthy levels. But when their starting valuations are elevated, you don't bet the benefit of that simply because, the stock derates over a period of time. So that's the complexity you need to keep in mind.
Yeah. The thing is, now the market seems to be grappling on both fronts, trying to find pockets where valuations are reasonable and trying to find pockets where at least you'll get some half-decent earnings growth, right? So, Vetri, help us out over here. I remember our earlier conversation. Financials, for instance, is a space that you've always liked. There's a big debate on FMCG now because FMCG stocks have not moved. Many believe that earnings from that very low expectations era will at least be better than what they used to be. But do you believe so?
Sure. So just quickly on both, I think as far as financials are concerned, Surbhi, we spoke more than a year ago. I think two big changes that have happened since then. One is that the RBI's thought process in terms of interbank liquidity has changed dramatically. The other thing which has changed is their approach towards risk weights. The way I interpret that is that they are now a lot more comfortable that the system has been cleaned up, and therefore they would be a lot more amenable to actually see credit growth accelerate. And I think that would be a wonderful thing for the financials. It's not yet happened. Credit growth is actually barely running at about 9% in line with nominal GDP growth. I would say, in fact, it's quite weak. But I think the trend line from here is likely to be higher simply because you've got RBI now clearly indicating in terms of its actions that they are amenable to higher credit growth. And I think that is good for the banks along with the easy liquidity. As far as FMCG is concerned, I know the stocks haven't done much in recent years. The other reason to look at them is that they're a little bit distanced from all the stuff that's going out in the context of, value chains and global trade and tariffs and all of that. But I just feel that the starting valuations there are still not really at a level which gives me great comfort. If I were to look at a sector where I had more relative comfort, I would actually say the Indian healthcare sector in general. And you remember the Indian healthcare sector is very well diversified now across domestic drug producers looking at global markets, the CDMO type companies who are doing contract work. Then you've got diagnostics, you've got hospitals. So I think that's a sector which, to my mind, slightly remote from some of these other issues, and at the same time, very diversified set of companies which is reasonably well placed to do well over the next few years. So banking and finance followed by healthcare would be my preference.
I think absolutely, Surabhi, on the financial point, we've of course seen this big pivot from the RBI, which I think has been well acknowledged. I met a couple of bankers over the weekend, and the RBI regularly calls for feedback, right? I mean, they'll ask and say, what else can we do? Yes. I mean, sense I got is that they are really eager. Tell us what we can do to spur growth. So they really want to kickstart another credit cycle. That's the clear message.
Which bodes so well, right?
Which bodes well. I mean, they really want to push growth. And one person said, well, I've not seen this kind of an RBI.
Focused on growth.
Focused on growth in a while, So I think that existing regulations, can we repeal some of it? Some things you think are draconian, et cetera, et cetera. I mean, things like PSL. We've discussed some of this in the past, but I think... and I think that is one reason why many who we speak to regularly are quite kind of focused and bullish on financials as a space. But the point is, if credit growth picks up, I mean, it shows up everywhere. Yeah. It's just that banks are economy facing and kind of it shows up there first.
Yeah, I think we were talking a lot about the Fed pivot. Well, all eyes were on the RBI. The pivot came here.
That's what I said, right? We were joking about it, remember? That Mr. Trump, maybe he'd want to take a leaf out of our RBI governor's book and, send some lessons to Mr. Powell. That's on a lighter note. But thank you very much, Vetri. Great conversation as always. So we'll keep our eyes very focused on financials to see how it starts playing out in numbers. The RBI is a new, far more supportive and accommodative stance with respect to growth. So thanks for that. The market continues to sort of grind along 70 points lower. So it's not kind of... The good thing is that the ground is not sinking in. It's not caving in. It's still fighting with about a 70-80 point sort of a cut. Now let's focus on a company that is all set to come to the street. We're talking about Bengaluru-based Anthem Biosciences. They're doing an IPO. It's an issue where they're looking to raise about 3,395 crore rupees. This is entirely an OFS. The price band has been set at 540 to 570 rupees per share. The company has raised a little over 1,000 crore rupees from anchor investors ahead of the public issue. So we have with us the chairman and managing director of the company, as well as CEO, Ajay Bharadwaj, and the CFO, Goyer Beg. Thank you, gentlemen, very much for joining in. Mr. Bharadwaj, let me start with you. So just explain to us, I mean, I was going through your business verticals as well. The growth has been very, very steady. You've managed over the last couple of years quite a steady run at the top line level. We're talking about, I think, over 35%, almost 35% growth coming through. Your margins are close to 36% as well as of FY25. So this space that you're in, CRDMO, just tell us about your pipeline, the big companies that you're operating with, and what makes you confident about growth prospects.
Yeah, first of all, thank you for having us. First let me explain what the Contract Research Development Manufacturing organization is. It's a new age business, and it's a very knowledge-based business. We actually are partners to global innovator companies, helping them discover new drugs. So that, in a sense, it's very different from what we understand as the normal pharmaceutical business in India, which is largely generic space. We, on the other hand, are partners of choice for global innovators to help them discover new drugs. So we do end-to-end discovery. We start with discovery, development, and all the way up to manufacturing. So as the molecule or a potential drug candidate progresses from early development all the way to manufacturing, it has to go through many gates, right? This is a highly regulated business. Anthem is able to assist global companies at each step.
So help us understand what that model means in terms of how the revenue flows or the revenues accrue. I mean, I'll just give you an example of the latest big headline in the Indian pharma R&D space is coming in from Glenmark, right? Now, they have a very different model. They developed a drug and then they've sold it to an innovator, and then they get certain upfront payments and milestones, etc. So when it comes to generating revenue, how does your partnership with the global innovator giants work?
So actually, if you look at it, it's very similar to what's happened with Glenmark, as you said. There are companies which are, emerging biotechs. They are in these centers of excellence around the world. It could be Cambridge in Massachusetts, San Diego, San Francisco, these kind of places where there is a lot of talent and there are brilliant universities there who generate a lot of knowledge, new knowledge. So people form companies in partnership with either professors or ex-employees of big pharma, and these companies get funding from the venture capital funding, which is available plenty in that area. Once these companies are set up, they're very small, head count. They have no labs. So we become their wet labs. In the sense, they give the development responsibility to us. Now, for them to do that, they have to have enormous amount of confidence, both in your ability to do this, as well as the other parts, which is your credibility, your ability to keep it confidential and protect their intellectual property, as well as their name. Because that's when you ask, who are our customers? We're not at liberty to disclose them because our agreements forbid us to do that. Then if these companies start to succeed, let's say, and it takes 5 to 8 to 10 years sometimes before the molecule moves to phase 3 and is near commercialization, then almost always they get acquired by big pharma.
Right.
Just like this molecule has been taken by AbbVie from Glen. So, we would do the development for these companies. And finally, we do go into supplying big pharmas, and that is also the big part of our story. So our revenue flows come from molecules that we helped discover and are now commercial.
So go ahead. Would it be correct to understand that there is, during the life cycle phase, which could be running into several years, you get, so to speak, a service fee for all the lab work and R&D you're doing. And if the molecule actually reaches the end point and commercialization happens, then you are open to what, additional milestone payments?
So, yeah, you're right. So we agree to what our model, as opposed to several other of our peers, which is their model is full-time equivalent. Ours is fee for service. So we agree on milestones. And when we deliver those milestones, we get paid. And then we move to the next, then we set the next milestone. So in the end, when the product goes commercial, because arguably we know most about it than anybody in the world, because these are all de novo molecules. These are new molecules.
Yeah.
So it does stay with us. So whoever acquires it also would say, we want to keep it with these people because you know the most about it. If we have the ability to have the manufacturing capability, the scale, which we have, as well as the compliance track record. So because, again, this has to go through all the FDA approvals and all the rest.
Can I ask you a question about the IP
go ahead.
itself? So this is the OFS, complete OFS. And it's correct me if I'm wrong, compared to Divi's and others, priced a little aggressively. You want to take that question?
I'll take that. See, with respect to this OFS, with respect to the IPO, this is a complete OFS, and the price band that we have set has been in consultation with our BRLMs, and we've been on the roadshow for the last 3 months, and based on that, we have set on the price band. And even last Friday also, we've got our anchor book done, and a lot of marquee investors have come in this anchor book as well.
FY20, based on FY25 earnings, almost about 65, 70 times earnings, right?
Yes.
On a price to earnings multiple. That is, what kind of growth are you expecting? Anything you can tell us broadly?
See, what we have done is, we have built our facilities, which is highly compliant facilities from a US FDA point of view. Both our facilities have gone through US FDA audit 6 times. Now we are coming up with a third facility, which has also been commissioned over 2024 and 2025. Now we are starting work on our Unit 4, which is a large-scale expansion on a 30-acre land block. So the ingredients of the growth is something what we have put in.
Long-range forecast, Mr. Beg, would you be able to put some numbers to it?
At this point of time, we won't put any numbers on the long-range forecast, but historically, we have grown at a CAGR of about 24%. Our margins have been quite steady. We've been at about 36 to 37% EBITDA margins and about 23 to 24% PAT margins. And you talked about the IPO being an offer for sale. The reason being it's an offer for sale is we are sitting on net cash of about 625 crores. Plus, there is cash generation in the business. It's a cash-generating business. So we are in a self-sustaining model to be able to sustain our manufacturing expansion by using the internal accruals and cash being generated. And that's the reason it's an offer for sale.
All right. Good to have you in the studio, gentlemen. I was looking at the numbers, and maybe one of the reasons that you all have priced it so aggressively is because you all have grown faster than competition and margins are relatively better as well. But just a quick word on the margins parameter. The margins that you mentioned, mid-30s in terms of EBITDA, and PAT margins, I think mid-20s. You can hold on to that. Not asking for a concrete guidance, but that's the aspiration?
That's the aspiration.
Got it. All right, so that's out of the way. Also, a couple of more questions. Specialty ingredients, I think that's around 18% of the mix, right? Could you tell us how are margins different out there? And if you could tell us, where do you see that number scale from around 18%? So that's point number one. Point number two is, you have cash of 600 crores. How will you utilize this cash? Please go ahead.
Yeah. See, specialty ingredients is also a very niche business that we have. It's a fermentation-based business where we are selling a lot of nutritional-based products, mostly actives across probiotics, enzymes, nutritional actives, vitamin analogs. And it's a high-growth market because a lot of this products in this space is not something which is coming under price control. So most of our customers are looking at selling these products, and to whom we supply are the drug substance or the drug actives. Historically, specialty ingredients have been hovering for us in the range of about 20 to 25%. And I think broadly going forward also we would continue to be in that same range. This year it has been about 18.65%, but broadly it would be around the 20-odd percentage level.
All right, we got that out of the way. And cash utilization?
Yes. As on date, we have about 109 crores of working capital debt and about 735 crores of cash, mutual fund investments in bank and bank deposits. I think over the course of the next couple of years with cash generation, which could be about close to 300 crores a year, we'll be sitting with close to about 1,000 crores plus of cash, which we will use for our Unit 4 expansion. That's the large-scale expansion which you're looking at doing.
Just one last. I think 5 odd customers contribute 70-75% of your revenues, right?
54.
Yes, 70%, yes.
70%.
70%. Yeah. And the model that you described was you get paid as you go based on milestones, etc.
Right.
Right. Is there a risk because it's so highly concentrated? I mean, if something does not work out with one client, and 5 or 70% of your revenues, I mean, there is it kind of becomes lumpy in that sense?
No. So let me again explain. The commercial products that we have, those are very linear. They are continuously growing and they have very long extended patent life still. So
there are 13. Sorry, so I want to just understand. Right now, you have 13 products which are commercial, right? So that's steady state. There's no discovery or development risk over there.
So that becomes like a regular, very linear business.
It's like annuity, yeah.
And growing because those molecules are growing globally. And 4 of them are blockbuster drugs, which means they have crossed more than $1 billion in sales. And we support them as a major supplier. And on the milestone part is the discovery part. So that part is the part where we get paid as the molecule progresses. See, in our business, you want to ask something.
So just to go back to Prashant's question as well, the risks. Since you have a client concentration of 5 and the commercial molecules are 13, there are many which are early stage, some late stage, some discovery stage.
Right.
What about the risks when you don't meet the milestones and you're concentrated with 5 clients?
No, these are not the 5 clients are commercial.
Okay, those are 5 commercial clients.
We have 150, nearly 150. So that's why it's a little. It takes a little while to understand. There are 150 discovery companies that we are working with. So these molecules, and it's the nature of the business. Many of them fail, but neither do we. We get paid because it's still
R&D.
We still do development. And the good part is when a product fails, and these companies usually then go belly up, but the people who are working in these companies go and join or start another 3 new companies. So potentially you now have another 3 new because you never failed them, right? So actually this is why we've been in business 19 years now. So I mean, I can say very confidently that we have in that ecosystem of drug discovery a very good name. And in this, word of mouth is also really important because people who have worked with you, they can vouch for you.
Matters for a lot. Thank you very much, gentlemen. Great speaking with both of you. And I hope you will come back and we can have a longer chat. We're constrained on time, but wish you all the best of luck.
Thank you so very much.
Well,
thank you.
All the best. We look forward to you speaking to you all on listing day yet again.
Thank you.
Well, let's get back then to a couple of listed companies. Their newly listed Oswald Pumps has reported its Q4 FY25 earnings. The revenue jumped 50%. The EBITDA margins as well expanded by 750 basis points. But it seems the street wanted a little bit more. And that's why we saw the stock see some profit taking in Friday's trading session. We have with us Mr. Vivek Gupta, the chairman and managing director at Oswald Pumps, who joins us on the show. Hi, Mr. Gupta. Good morning. Thanks a lot for joining in. Well, you've doubled your revenues approximately, every 2 years or so. For this year, FY26, what kind of growth expectations you're talking about, if you could help us out with the guidance? And also, though the numbers have been looking very good, last year your cash flow, in fact, went into the negative. How confident are you of returning back to cash flow positive in this year? If you could give us some color on that front. So revenue growth, margins, and cash flows turning positive. Please go ahead.
Okay. Very good morning. Basically, can I talk in Hindi?
Yes, sir.
Yeah. So if you see the last year कंपनी ने year on year एक बहुत अच्छी ग्रोथ ली है, जो कि करीब आप देखेंगे तो 176.5% के करीब हम लोगों ने ग्रोथ ली है प्रॉफिट और मार्जिन में, EBITDA मार्जिन में. एंड जो हमें इस पूरे आगे का सीन दिख रहा है ओसवाल में, बहुत अच्छी ग्रोथ दिख रही है, क्योंकि पीएम कुसुम 2 बहुत एग्रेसिवली गवर्नमेंट काम कर रही है. एंड पीएम कुसुम 1 के फिनिश होने से पहले ही कुसुम 2 बहुत तेजी से लॉन्च होने वाला है. और इनफैक्ट पीएम कुसुम 1 को भी फिनिश होने में एटलीस्ट कैलेंडर ईयर जून 26 तक का टाइम है, जून जुलाई तक का. सो वी आर क्वाइट वेरी सेफ एंड वी आर एक्सपेक्टिंग वेरी गुड प्रोग्रेस एंड गुड ग्रोथ. सो डेफिनेटली एज पर प्लानिंग ऑफ Oswald Pumps, still there is no doubt. And as
मिस्टर गुप्ता, एक अगर मैं सवाल पूछ पाऊं आपसे, एक तो कुसुम सेल्स जो है, कुसुम का जो प्रोपोर्शन है सेल्स मिक्स में, वो गिरा है इस बार, कुछ 11% नीचे है. मार्जिन्स भी काफी कम है कंपेयर टू द एनुअल एवरेज. तो आप कुछ एक गाइडेंस दे सकते हैं FY26 के बारे में, बोथ टॉप सेल्स ग्रोथ एंड टॉप लाइन ग्रोथ, कुसुम मिक्स एंड मार्जिन्स?
ओके, देखिए एक्चुअली हम लोग ईयर टू ईयर ग्रोथ को एक लेके चलते हैं, और क्वार्टर टू क्वार्टर हमारे सेल्स मिक्स का वेरिएशन हमेशा रहने वाला है, क्योंकि हमारे पास पैन इंडिया नेटवर्क जो हमारे अदर कस्टमर्स है वो भी हमें सस्टेन करने हैं. सो ये कंपनी एक बीच में स्ट्रेटेजी कॉल लेती है ताकि अपने कस्टमर्स को सस्टेन कर सके, कि सारा टोटल सेल्स हम अगर प्रोजेक्ट की सेल करेंगे तो हमारे जो रिमेनिंग कस्टमर्स है वो सफर होंगे. सो वो रहेगा. बट ईयर ऑन ईयर अगर हम देखेंगे, सो हमारा जो प्रोजेक्ट सेल्स है वो भी इंक्रीज, बहुत अच्छी ग्रोथ लेने वाला है. और हमारी पैन इंडिया जो नेटवर्क सेल है, एक्सपोर्ट सेल्स है, सो अकॉर्डिंगली वो भी हम लोग बहुत फोकस कर रहे हैं. सो ये क्वार्टर टू क्वार्टर थोड़ा बहुत सेल्स मिक्स में डिफरेंस रहेगा, बट कंपनी का आउटलुक बिल्कुल क्लियर है. कंपनी ईयर ऑन ईयर बेसिस पे ही अपने मार्जिन्स लेके चल रही है, अपने प्रोस्पेक्ट्स लेके चल रही है.
तो क्या नंबर्स हैं वो FY26 के लिए गुप्ता जी?
देखिए FY26 में बेसिकली हम लोग साइलेंट पीरियड में चल रहे हैं. सो यहाँ पर हमारे कंसर्न है कि हम लोग बहुत क्लियर व्यू नहीं दे सकते.
नहीं सर, तो आप ये बता दीजिए मिस्टर गुप्ता, आप ये बता दीजिए कि लेट्स गो बाय योर मिक्स. जो आपकी रेवेन्यू FY25 जो जब खत्म हुई, तो वो जो मिक्स था आपका पीएम कुसुम से जो बिजनेस आ रहा है वर्सेस द नॉन पीएम कुसुम बिजनेस, वो मिक्स एक बार हमको दोबारा बता दीजिए एंड टेल अस वेदर इट विल स्टे द सेम या उसमें कुछ वेरिएशन होगा.
देखिए नॉर्मली कंपनी का मेजर फोकस प्रोजेक्ट सेल पे है. सो अभी तक की हिस्ट्री अगर हम देखते हैं, 70 to 75% का हमारा क्वार्टर 3 तक का मिक्स रहा है प्रोजेक्ट सेल में. और यही रेशोज, इसी के आसपास की रेशोज हम लोग आगे मेंटेन कर रहे हैं, और मे बी 2-4% ऊपर नीचे. बट प्रोजेक्ट सेल्स में बहुत अच्छी ग्रोथ दिख रही है, क्योंकि पीएम कुसुम 2 में गवर्नमेंट बहुत एग्रेसिव है. और चूंकि हम लोग एक लीडिंग मैन्युफैक्चरर है, सबसे बड़ी कैपेसिटीज, सबसे ज्यादा नंबर ऑफ पंप्स इंस्टॉल्ड अभी तक ओसवाल के पंप्स हुए. सो एंड एलिजिबिलिटी क्राइटेरिया ओसवाल के पास हर एक स्टेट्स में अवेलेबल है. सो ओसवाल यहाँ पर बहुत एग्रेसिव है और बहुत ऑप्टिमिस्टिक है कि इससे जो प्रोजेक्ट सेल्स मिक्स हमें पहले मिले, शायद हम इससे भी अच्छे नंबर्स अचीव कर पाए.
अच्छा, एक चीज और मिस्टर गुप्ता, दैट योर रेवेन्यू हैज बीन ग्रोइंग at a very fast pace. Your profits are also higher. But this is not showing up. जो आपका cash flow है, उसमें इतनी जल्दी conversion नहीं हो रहा है. So why is the delay? In fact, आपका cash conversion cycle 135 days आ गया है. End of FY25, end of FY24 91 days था. तो कैश कन्वर्जन साइकिल क्यों बढ़ रहा है? व्हाई इज द प्रॉफिट नॉट ट्रांसलेटिंग इनटू बेटर कैश फ्लो?
ओके, देखिए हमने गवर्नमेंट प्रोजेक्ट्स में पार्टिसिपेट करना शुरू किया एंड ऑफ द FY24 के क्वार्टर में। और चूंकि हम धीरे धीरे हर एक स्टेट्स में एक्टिव हो रहे हैं, सो गवर्नमेंट साइकिल्स करीबन हमारा 150 to 160 डेज का जो साइकिल था, पीछे आप देखेंगे तो वो साइकिल चल रहा था, जो कि इस साल में बहुत तेजी से धीरे धीरे रिड्यूस भी हो रहा है, क्योंकि गवर्नमेंट इसमें एक्टिवली हम सब के लिए काम कर रही है। वो चाहती है, गवर्नमेंट चाहती है कि हमारा जो साइकिल है, पेमेंट साइकिल है, बहुत रिड्यूस हो। और वी आर वेरी मच ऑप्टिमिस्टिक, ये जो साइकिल है बहुत तेजी से रिड्यूस होने वाला है इन कमिंग couple of months. We are very much optimistic कि अगर आप एंड ऑफ दिस फाइनेंशियल ईयर देखेंगे तो ये जो कैश कन्वर्जन साइकिल है ये बहुत अच्छा खासा रिड्यूस होगा। एंड सेकंड, चूंकि अभी हम लोग नए नए गवर्नमेंट प्रोजेक्ट्स में आए थे तो थोड़ा सा कैश फ्लो नेगेटिव था, बट इस साल वी आर वेरी मच ऑप्टिमिस्टिक कि हमारा कैश फ्लो पॉजिटिव होने वाला है।
ऑलराइट, कैश फ्लो पॉजिटिव होने वाला है एंड मे बी जब आप साइलेंट पीरियड पे नहीं होंगे तो फिर बात करेंगे with some specific numbers for FY26. Thank you very much.
Thank you very much
for joining us. We'll take a quick break here. We'll come back and what we'll do is we'll put the focus on a sector as always. Quarter se quarter tak is our segment which is coming up. Vivek Gupta we'll have Gaurav who will be joining us in just a bit from now to run us through what his expectations are for the first quarter from the banking space. That's coming up in just a bit.
Welcome back. Just a quick check at the market, and it's managed to cut its losses. The Nifty, which was at one point in time down almost 100 points, is now down only 40 points. This is good. There's some buying happening at lower levels, so bulls would be pleased with the way things are turning around. The mid-cap index is doing a lot better. Mid-cap index is up a whole 0.5%, nearly 0.5% in positive territory. Well, let's continue with our special series, Quarter Se Quarter Tak, as we prepare you for the upcoming earnings season. We've got Gaurav joining in. How the first quarter could be for the banking sector. Over to you, Gaurav.
Well, yes, investors' interest in the banking segment is rising, and the reason being that if you look at Bank Nifty, it recently reached its all-time high level. But when we look at Q1 numbers, can we expect the same numbers from Q1? So let's understand a few factors. RBI has now delivered rate cut in the range of around 100 basis points. On the other hand, when we look at system credit growth, that has come down to around 9.6%, which was as high as 20% just a year ago. And considering all these factors, now there are two concerns specifically for the bank. First is that the slowdown in the loan book growth, and second is the slowdown in the net interest margins. First, let's understand the loan book growth aspect. From what we have seen in the provisional update, we have already seen that banks, large sector banks like Kotak Mahindra Bank and some mid-sector banks like Bank of Maharashtra have delivered very strong growth. But on the other hand, we also have IndusInd Bank, Union Bank, who reported weak set of numbers when it comes to provisional updates. Now, considering this factor, if we look at the small finance bank, there the picture was actually even more bad, because excepting AU Small Finance Bank, there were some banks who reported very weak set of numbers if we compare it with its weekly previous average levels. And specifically when it comes to the asset quality also, there also we saw some concerns because bank like Equitas actually reported very sharp spike in their retail slippages. Let's also not forget that there were also banks like CSB who outshined because of their gold portfolio. So that was another concern which was there from the market, but it was not seen in the CSB bank. But from the NIMS point of view, we may see some kind of pressure because of all these activities which are happening. NIMS are expected to go down almost by 8 to 30 basis points. In fact, we have got a list of banks. For example, when we look at some banks like SBI, Bank of Baroda, PNB, and a bank in the like of Axis, we may see NIMS going down in the range of around 10 basis points. For bigger banks like HDFC, ICICI, and for the banks like Federal Bank, the NIM drop down can be somewhere in the range of 15 to 20 basis points, and it will be higher for the banks like Bandhan, RBL, and even for the bank like the small finance bank, where we have seen unsecured portfolio which is higher, and now these banks are actually shifting their focus to the secured portfolio. Let's also not forget that for IndusInd Bank, we may see an uptick in the net interest margins on a sequential basis because there was a one-off in the last quarter. But let's also not forget about the asset quality concerns. When we talk about asset quality for slippages, Q1 is usually slower in terms of asset quality, and that is the reason we will be watching out on ICICI Bank, HDFC Bank, in fact in SBI as well, because we may see some uptick in slippages. On the credit cost front, there will be some pressure on the banks where we have seen asset quality was deteriorating, specifically in the likes of Bandhan Bank, RBL Bank, IndusInd Bank, where we may see slippages and credit cost remaining higher despite being a drop on a sequential basis. Now, let's not forget that for Axis Bank, they have actually tightened their norms, and that is the reason we will be watching out on slippages as well as credit costs for Axis Bank. Lastly, considering all these aspects, when it comes to the earnings, we may see some drawdown in earnings as well. For PSUs, there may be some gain, but for the likes of HDFC Bank and ICICI Bank, we may see the momentum somewhere remaining around in the single digit when it comes to EPS growth. And for the banks like Axis Bank, SBI, and even for the bank like Kotak Mahindra Bank, we may see some drop. For the banks where we have unsecured exposure, we may see a bigger drop somewhere in the likes of around 20 to 30% for Bandhan Bank, RBL, and even higher for IndusInd Bank. Now, considering all these aspects, do we really are concerned about the overall outlook for banks? Well, it is unlikely, because when it comes to the outlook, many of the investors believe that this is going to be an event only for a quarter or two. In fact, Macquarie recently wrote a note where they believe that there will be some uptick in the bank's net interest margins. In fact, they believe that in FY27, we will see NIMS actually recovering to the full extent, and the private sector banks can also grow their EPS at around 15% over the next 3 years. So definitely, there are a few concerns in Q1. We may see some slowdown, but that does not mean that the banks are going to lose their shine. And on the back of that, we will be watching on the sector in coming days.
All right, Gaurav, thank you very much. Very comprehensive QT on banking. Ajit Kumar is lead BFSI research analyst at JM Financial Institutional Securities, is with us. Ajit, good to have you with us here. Thank you for your time. So across the board, I mean, I think as Gaurav comprehensively outlined, there is decline in margins, which is expected, some bump up in credit costs, etc. as well. How do you approach this season? It's going to be, of course, when we know, we'll know, but these are largely modeled in since NIMs will be lower because of course, rate cuts, etc. What's your sense?
Yeah. No, good morning, everyone. I think, Gaurav has summarized this, beautifully. Gaurav is absolutely right. We have the latest credit growth data till 27th of June, 2025. Now, the interesting point is YTD credit growth is roughly 1.3% versus, let's say, 2.8% last year. So credit growth definitely is lower as compared to last year. And on top of that, there is a margin compression which is going to happen across the board. Let's say, for the large banks, we are expecting roughly 10 to 20 basis point of margin decline in 1Q. Even in second quarter, there should be at least 10 to 15 basis point of margin decline in second quarter before recovering, let's say, by fourth quarter of this financial year. So net, because of this moderating loan growth and let's say margin compression, NII growth for our coverage banks it's not more than 2 to 3% on a YOY basis. And 1Q is normally seasonally weaker quarter. But even if we adjust for the seasonality, my sense is 1Q is going to be even more weaker quarter for the most of the financials name. On the asset quality side, yes, slippages are going to bump up because in the large bank, there is elevated agri slippages that come in first quarter. And on top of that, you have unsecured loan, which is a bit of pain still now. So net, your credit cost is going to be higher. So combining for all the banks that we cover, the PAT growth is going to moderate to roughly 8 to 9%. Versus, let's say, 6% decline that we had seen in fourth quarter. So this quarter as well, we are going to see, PAT declining by roughly 8% on a YOY basis in 1Q26.
All right, well, that's just hold on to that thought. Ajit, we have a newly listed company, Travel Food Services. It lists at a bit of a premium in comparison to what the IPO price is. And there's quite some ringing going on there with regard to that bell. So, management sounded optimistic about growth, profitability, and ROCE of, I think, 50% is what they were mentioning as well. The hugs are there, a green listing out there. I think the grey market premium had come down a little bit, but the stock opens up in the green. So I think, those smiles are quite bright and broad out there.
Yeah, I think
and the ring was quite something.
Yeah, I'm sure there'll be some good food as well at that listing ceremony.
Better be.
Well, that's Travel Food Services. They offer, of course, food and beverage services at many, many airports. Big
All
airports.
the youngsters as well are quite happy to be part of that.
Yeah, it's one big happy family there at TFS as the company makes its listed market, public market debut today. We'll keep an eye out on how that share behaves as the day progresses. But just to get back to that conversation on financials with Ajit. Ajit, so, okay, let's just break it down in terms of, first of all, from an investor's perspective, should we be, when we're watching out for the biggest delta, should we be looking at the biggest growth outliers? And in which case, which could those banks be? I think the consensus is tier 2 banks will probably be tier 1 banks when it comes to growth. And when it comes to the margin delta, perhaps the best margin performance, the least drop in margins, etc., then which could be 2 or 3 of the banks which could surprise on the margin front? So tell us both.
Yeah. No, I think on the growth side, some of the smaller banks have done relatively well. Like, for example, AU Small Finance Bank, they have reported, good set of numbers, especially on the growth side. My sense is PSU banks, YOY growth is going to be higher as compared to private sector banks. And this has played out in last quarter as well. Even in this quarter, the banks who have reported their numbers till now. For PSU banks, YOY growth is roughly 11% versus, let's say, 6 to 7% growth for the private sector banks. So PSU banks are growing faster as compared to private sector bank on a YOY basis. And then even on, let's say, some of the smaller bank side, let's say, for example, AU Small Finance Bank, Karur Vysya banks, those guys are delivering, better on the growth side. Now, on the margin side, my sense is some of the mid-sized bank like City Union Bank, where most of the loans are fixed rate in nature, their, margin decline is going to be lower. Then some of the large banks, margin decline is going to be somewhere in the range of 10 to 15 basis point. But for the other banks, right, like, for example, all the other mid-tier banks and small finance bank, our sense is margin decline is going to be even more sharper. It's going to be somewhere in the range of 30 to 40 basis point. And the reason for this is there are two drivers of actually, this margin decline. One, obviously, the, policy rate cut that has happened, let's say in last, 2 to 3 months. The second issue here is mainly because of this stress in unsecured loan, most of these mid-sized banks and NBFCs are getting into secured loan all at the same time. So everybody wants to get into vehicle financing. Everybody wants to do affordable financing. So what is happening is there is a loan mix shift which is happening from unsecured to secured, and that is putting pressure on the yield side. So there is a mix shift which is happening from unsecured to secured. And as a result of that, there is elevated competition in the secured loan. So there is a pricing pressure as well in some of the secured segment. So yield is coming under pressure, and that is why we believe that for mid banks and NBFC, the margin outlook is even more muted. But coming to your question on the margin side, our sense is City Union Bank and large banks are going to surprise positively, or at least their numbers are actually baked into the expectation.
Okay, and very quickly your top picks then, just quick 30 seconds.
Yeah. So, ICICI Bank continue to remain our top pick. ICICI Bank, SBI, even Axis Bank remains, our top pick. In mid banks, City Union Bank and DCB, continue to remain our top pick. In NBFCs, we like, Bajaj Finance and PNB Housing Finance.
Okay. All right, Ajay, thanks a lot for joining in and giving us that view. We look forward to chatting up with you as the numbers keep trickling in. For the time being, let's get back to the markets. And we've seen a good recovery. As we pointed out earlier today, we're not ruling that out because the PCR had come down to the lower end of the range. And there are shorts in the system, 1 lakh contracts of FI net shorts. Midesh Thakur is back with us. Midesh, would you be looking to sell into this sort of a bounce? We've recovered close to 80 points in the day's low. But I think we're still a little bit weakish till we get past at least the first hurdle, which will be at the 20-day MA. Tell us your trade on the Nifty and fill us in with a couple of stock trades.
I think, we have taken some put spreads. So basically, it's not a direct short, but it's an indirect short when the money will be made if the markets kind of decline a bit. So I think that would be a good strategy, given the fact that we have slightly tapered off from 25,600 to 25,050, which is today's low, without any kind of a pullback. We take a put spread, but as we get closer to 25,200, I think that's the area where you would want to be aggressively short. So another 180, 100 points higher, you would want to explore shorting in the futures as well. The idea is that overall market, I think, could possibly decline to about 24,850, 860 zones, and that is the area where I'm looking stock support to come.
Okay. 24,850 eventually. That's what you're saying? Mitesh?
I'm working with that kind of a transaction. That's right.
Oh, okay. I mean, the 40-day exponential, which we put out in the morning, is 25,000, basically 25,000. 25,018 is the 40-day as on Friday exponential as on Friday's close. We'll see if that comes into view. The Nifty Bank, 56,800 so far. Yeah, it's still not. I mean, it's still 100 points away from its 20-day, which is about 56,700 or so. The Nifty Bank did not break the 20-day on Friday, unlike the Nifty, which actually did. We'll take a quick commercial break, and I think what we'll do is we'll look at some individual stocks, etc., which are going to be in focus. Stay tuned, coming up.
Welcome back. So, a slightly choppy morning for the equity market, but let's figure out what's happening in the world of commodities. We have Manisha joining in, who's been telling us that, gold can move aside. It's silver that's been sparkling all the way through. So, which one is it, Manisha? What's catching your attention this morning?
Well, Bitcoin and silver both trading at an all-time highs, but I will take you through across our precious metals on how the trades really have been. You know what? There's the safe haven buying which really has come back into many of these precious metal prices. One, for them, it's supply tightness. For the white metals, that is, there's an increase in demand as well. And to ship many of these metals, it is the freight rates which also have been trading on the higher side, supporting prices on the upwards there. I'll start with gold because that one is trading at a one-week highs. We're looking at more than 0.5% of gain in the Asian markets right now. It absolutely has to do with safe haven buying. And then we also are looking at US widening the global trade wars with the new tariffs, and that clearly has been supportive. So that's about gold. But take a look at the silver prices, 13-year highs onto that one. Platinum and palladium also trading at a multi-year highs into the trade right now. Silver clearly should be on your radar because we're trading at a 13-year highs in the international markets. We've seen 3 weeks of constant gains. For the Indian markets, we are trading at 1,14,000 rupees a kg, which is an all-time high. Add to that the GST and the making charges, and you'll take the prices much higher from here. The investment demand has been strong, and a lot of silver guys tell us that it is the physical buying in sense of jewelry as well, which really seems to be doing well with what gold is doing, and the silver prices clearly seem to be supported with that as well. If you look at the overall price movement, then we've seen 3.5% of gains on Friday. For the year until now, it is 34% of gains that we've seen in silver. It has been 6 consecutive weeks of gains that silver also has posted. It's trading at an all-time highs in India, with the markets telling us that 1,25,000 is what you can expect to see in silver by the time it's Diwali. But it doesn't end there, because take a look at the platinum prices. We've seen 30% of tariffs coming on Canada, Mexico, Japan, South Korea, and that really seems to be impacting palladium prices at this point in time. Safe haven demand is one part of it. The trade war is yet another, and that safe haven buying seems to be coming in case of platinum and palladium as well. I want to take you through a last final plate which tells you on what we've done in sense of price movements in this year until now. So there you have gold, which made an all-time high in the first quarter of this year itself, is holding with its 28% of gains. Silver has been doing a catch-up, all-time highs in the Indian markets, 33.5% of gains until now. But clearly, it is about platinum. Last quarter saw platinum prices gain up by 40%. And the month of July has seen yet another 15 to 20% of gains, giving you a 60% of a return there. And palladium, because of shortages, deficits, etc., also has been doing quite well. So it really has been about the white metals within the precious metals, which have given you very, very strong returns.
All right. Manisha, thank you very much for that. Precious metals and are getting more precious in that sense, as Manisha puts it. We'll take a quick commercial break here. It's our special segment. It's the Economy Lata in Conversation with Ashish Gupta, Chief Investment Officer, Fixed Income at Axis Mutual Fund. We, of course, also will talk about the latest as far as SEBI versus Jane Street goes. Stay tuned.
Welcome to It's the Economy. Money Control has just reported that Jane Street has deposited 4,843 crore rupees with SEBI and can start trading. But this isn't acknowledgement of guilt. The Wall Street Trading Company will eventually challenge SEBI's order in SAT. What are its chances of winning? Well, SEBI has accused Jane Street of manipulating the constituent shares of a bank Nifty index by pumping up the share market prices and luring retail investors to go long in the option markets, and then by the end of the day dumping the shares in the cash market and thus making huge profits on their own sell options, put options taken in the options market on Bank Nifty index. Now, to understand SEBI's order over the weekend, I spoke to one of the best experts on the field of options trading, Ashish Gupta, the CIO at Axis Mutual Fund. Ashish was the first one to point out in a paper called Gamification of Equities the unusual rise in volumes in India's index options market. I began over the weekend, this interview was over the weekend, I began by asking him the central question. Jane Street claims it was doing standard index arbitrage trading. But SEBI has shown with a mountain of data that Jane Street pumped up share prices in the morning and dumped them in the last hours so that it could profit in the options market. Does SEBI have a solid case to prove manipulation? That's my first question to him. Here's the chat.
I would not like to comment on a particular entity's trading pattern, and frankly, that information is visible and available only to SEBI, right? And they have talked about it in their order. The concern we have had, and the paper you mentioned that we wrote, was just that how large and disconnected the options market was relative to the cash market, right? If we talk about options really as a derivative instrument, it means that it has to be connected with what is happening in the underlying market, which is the cash market. And therefore, there has to be some similarity in both the volumes and the pace of growth in the what you see in options, or more broadly in derivatives, and what
Cash
we see in cash market.
Yeah.
Now, over the last 4 or 5 years, we had steadily seen the disconnect increasing. And as you mentioned, on a notional turnover basis, the option market notional became multiple times that of the cash market, right? If you, on the other hand, look at the other derivatives, right? If you look at the futures market, so the futures market is, of course, also larger than the cash market, but the future market notional is really 2 times that of the cash market, right? And this was at its peak nearly 400 times. Notional to cash has since then moderated. Yeah. Now, one of the big drivers of this was what was happening on the expiry day, what was happening on the last day. And again, as option pricing goes, there are 2 elements to it, really. One is the amount of notional that you are taking exposure to. And the second is the time you are taking that exposure for, right? And on expiry day, the time factor is so low that the price of the option is much, much lower, right? And that is what was really attracting retail investors to come in, because with a small investment or with a small size bet, you could actually look to take exposure to a large market. And if you recollect, SEBI had published this data last year about what proportion of total option market volume was actually happening on the last day, right? And in some instances, 80-90% of the volume was actually happening just on the expiry day, right? And so that kind of begs the question that if someone is looking to hedge exposure, why is he looking to hedge the exposure only on one particular day, right?
And for half an hour.
Yes,
that's
right.
true.
So clearly, and we had seen in terms of the number of retail participants and the kind of retail participants that were coming into the market, that more and more younger people, more and more people from tier 2, tier 3 towns were getting attracted by really the leverage the options market offered.
Fair enough.
And that really led to the outsized growth of the options market versus the cash market.
Yeah. No, all those points are taken. I'm sorry I'm dragging you back to the Jane Street order. I understand that you will not comment on another entity, especially when you don't know what they do actually. But the reply of the, we know we have the SEBI order, which is very, very detailed in terms of the number of shares purchased in the morning, number of futures options, futures purchased in Bank Nifty, and amount of options sold at the end of day. Those are very clear data given. Can that be explained as plain arbitrage, which is what some legal entities are saying? That this is just plain arbitrage. Is it arbitrage? But then, numbers are so different.
Yeah. So, frankly, arbitrage really is, and we in our mutual fund also run an arbitrage fund. Arbitrage really is when you take two positions of same, or if not same, similar size in two different markets, right? So theoretically, you can be doing arbitrage, taking a position on NSE and selling on BSE, or taking a position in the cash market and another position in the derivative market, right? Because in arbitrage, you are trying to play the spread between two different market or two different instruments, right? If the size is different, then clearly on one side you are taking a directional position, right? So then it is not really arbitrage, but it's a directional view that you are taking.
Yeah, that is the point perhaps that people are making. The other issue that some lawyers have made, or maybe some opinion makers have made, is that this may be unethical but not illegal. It may be aggressive but not illegal. Now, if you move the constituents of Bank Nifty in one way, and very clearly SEBI proves that in the morning when the prices are going up, they had 35%, 37% of the amount of trades, volume of trades, gross traded value. And likewise, even in the last half hour in the cash market, the positions taken by this entity was, 25 to 30%. Then can you really, isn't it very obvious, therefore, that they were driving the market?
No, so I think that comes out in SEBI's order. And actually, if you see it a bit more holistically over the last 9 months or so, SEBI has been trying to address some of these issues, right? One attempt, for example, has been to kind of tone down this over-exuberance of options trading by, I think, October last year, they came out with measures to increase the lot size, right? So really to dissuade.
No, 1 minute, Ashish. I perhaps didn't complete my question. When you look at the amount of shares with which that was sold in a particular segment, it does not give the sense of just unethical. It seems to give the sense of illegality. Do you want to comment on that? Because that seems to be the constant word. It is aggressive. It is not illegal. But then if you move with such intent, then it looks illegal. Your thoughts?
Yeah, see, frankly, intent is for the legal experts to kind of prove. What I'm saying is that why such strategies could work was the proportion between cash and the derivative market was very, very different, right? So cash market, as we discussed, is relatively smaller compared to the options market. The second part, and which is that in some of the indices, the index constitution is such that it is very concentrated in a few stocks, right? And in Bank Nifty, literally two banks account for more than 45% of the index weight, right? So then such strategies can kind of come out and really try to
they will work. I agree. These strategies will work. So the answer, Ashish, is the answer, therefore, to not have weekly futures. I mean, what are you hedging in a week? If I buy Kotak Bank today, What is going to happen in 1 week that will change? I mean, it may happen once in a way when there is a monetary policy or something. But as a rule, do weekly futures serve any hedging purpose?
See, I think it's a question that one needs to look at. Like, market has several instruments, right? And they are important, and market liquidity is created by investors, by hedgers, by speculators, right? Mm-hmm. So you need a certain speculative element also in the market, right? Yes. So, maybe the proportion of a monthly future versus or monthly option versus a weekly option, the number of investors versus speculators is very different. But for the well-functioning market, you need all kind of participants. I think it is important that we have the regulatory framework which kind of prevents really abuse of the system. Yeah. I think we have seen a fair bit of data consistently, and even last week, SEBI came out with the data that there were outside losses that were getting incurred, and again, not directly correlated to the other order, but it kind of emphasizes the need for it to act. And there have been several regulatory steps that have been taken. And on top of that, there is a supervisory or enforcement action that is actually coming in. And I think net, I don't disagree with SEBI that it needs to act on this. If you see the latest number, it is almost 1 lakh crores of losses.
Fair enough. But what would
put it in context?
Yeah, no, sorry, I'm interrupting because I'm running out of time. But what would your advice be? What more can SEBI do?
So I think there are various ways to control this further. I don't think necessarily you need to take out the index option, but I think having a broad-based index, having some degree of really limiting the retail participation, whether it is from lot size increase, whether it is from kind of having some side of accreditation of investors that is needed, because in really none of the large market options are available to all retailers to trade. And it is not just a market issue. I think it is a macroeconomic issue. Because the loss is so large, right? To put it in context, 1 lakh crore is about 6% of household financial savings in India, right? And remember, we have on a previous show talked about why household savings not growing and why bank deposits are not growing. So this is actually a large number in that context, 6% of household financial savings.
That's a fair point. Ashish, we're out of time, but thank you very much for joining me. Just one word, you don't think FPIs would be worried about this regulatory action, would they? This is not going to scare them.
So I think, frankly, there are various kind of FPIs, right? So there are these high-frequency traders, but there are also, we have multiple long-only and hedge funds that have actually been investing for a long time in the Indian market. And some of them actually have also been concerned. So when I wrote that paper, several people were concerned that option market is so disproportionate in India.
Okay. Well, so this was a conversation I had to have over the weekend because Ashish was traveling today. But I think Ashish is making a couple of points. Whether it is manipulation or not is one issue. We cannot allow it is the other part, because it's taking away 6% of India's household financial savings. That's an important point. And meanwhile, when we were speaking, we got the clarification from SEBI. I had written to SEBI asking whether Jane Street had deposited the amount. Apparently, they have deposited the amount and they've asked for certain conditions placed on them to be removed so that they can start trading. SEBI had in that order not highlighted exactly what those conditions are. So we await more clarity on exactly what are the conditional restrictions imposed on them. But to be sure, Jane Street will be aware that given SEBI's order, SEBI's